So today I'm here to introduce a very special speaker, Matt Chancey. Matt is the founder of Tax Alpha Companies. He's like the SEAL Team 6 for major taxable events. Nationally recognized as an expert, Matt has saved companies millions through his innovative tax solutions. He's been featured on major media outlets like the Wall Street Journal, Forbes, and CNBC. In 2024, he's launched his book. It's a national bestseller now in many fields, Tax Alpha Solutions, Effective Tax Management Strategies for High Net Worth Investors, under the Forbes brand. Let's give a warm welcome to Matt Chancey.
Thank you. That makes me sound so serious, and I do not take myself that serious. So, look, this started a long time ago. Like I'm 51 today. So 21 years ago, this journey kind of started. Some people from the outside in think that I'm a financial advisor, and I'm really not a financial advisor. I have a graduate degree in finance, but that's just not really how we apply the skill set. But what I've fundamentally done is spent the past 20 years figuring out all the things that are extremely complex that you rarely encounter in life. But when you do, they're significant and meaningful to know how to solve the problem. And I've collaborated with the people that actually work with the clients. So we really help educate. This is an education business. We educate CPAs, we educate attorneys, we educate commercial real estate people and business brokers. Obviously, the group here today is extremely important about giving back to the community. And a lot of that is through, the programs that you talked about. A lot of that's driven through philanthropy or planned giving. So most of the things that we talk about are meant to create stimulus in the community through economic growth and expansion, through understanding nuance in the tax code that allows entrepreneurs, to be able to redeploy capital in a way where they get more control over the redeployment of their capital versus being taxed, giving it to the federal government and letting the government choose how to redeploy their capital. Sometimes the government does a good job with it. Sometimes maybe not so much, right? That's a subjective thing, but it depends on how you feel about it. Okay. Disclosures. I have securities licenses and I have a whole bunch of licenses. So I have legal disclosure. This is for educational purposes only. I am not here attempting to convince you of anything. When I started getting pretty good at this stuff, I started getting media requests to talk about the kind of stuff that I've been in every national media publication there is. About 3 years ago, somebody from Forbes Publishing heard me give this presentation or some version of it somewhere before. And they're like, have you ever put that stuff down in a book? And I was like, I know. And over the past 3 years, we kind of put it on paper. It just came out a few months ago. That was a lot harder than I thought it was going to be. Now I certainly see why people write multiple books, because once you get it out of the way the first time, it gets a little bit easier, like anything else in life, I guess. This is the book, The Tax Alpha Solution. It just talks about a bunch of nuanced pieces of the code that don't show up all the time. So, okay. So one of the things that we talk about is the difference between traditional financial advisory type advice is kind of built for mainly mass affluent clients, which most people statistically are mass affluent. As you move up like the spectrum, you have what's called an accredited investor and qualified purchasers. Accredited investor back in the day when the code was written was 2% of the population. They have not changed the rules around that. And today it's about 19% of the US population. So 1 in people today qualify as accredited investor. And the federal government uses that as a line in the sand to determine who they deem to be financially sophisticated or not, based on the income they make or the assets they've accumulated. I think that's a terrible test, by the way, because I know people that have absolutely no money and are very financially sophisticated, people that have lots of money and are not real bright. So I think it's a bad test, but it's a test nonetheless. So one of the things that I realized there was a gap of knowledge in the marketplace for was how to access private capital markets. What most people might not realize is for every one public company out there that's raising equity or issuing debt for bonds, there are 99 private companies that are looking for equity to help their business grow or debt. And it's really hard to understand how to determine if a private company is investable. It takes a whole different level of due diligence background to be able to figure that out. But there are reasons that you would want to be there. Less volatility in the overall market and a higher return stream in the private markets. And I would say that's primarily because investor behavior doesn't sway what happens in private markets. Tesla doesn't go up or down, doesn't sell 10% more cars or less cars one particular day, but yet the stock can be that volatile. That absolutely makes no sense. And in private businesses and private markets, it doesn't function that way. It functions as a valuation is based off of cash flow. And cash flow doesn't vary that much on a day-to-day basis. So private real estate, it historically outperforms public real estate. It's because people can't buy and sell at the wrong times. Private real estate is less volatile as an asset class over time. It's because you can't just buy and sell whenever you want. You're more committed to it over a longer term horizon. And so what do I mean when I mean types of commercial real estate? Well, I mean all the food groups, right? Multifamily, self-storage, industrial warehousing, senior living, raw land, energy, subsurface rights. So there's lots of different ways to access private markets from a real estate perspective. And then from a strategic perspective, like Core Plus would be the most conservative, fully stabilized Class A apartment complex. As you move all the way to opportunistic, which could be ground up development, taking dirt in acres and then ultimately get it zoned, entitled, permitted, assemble the sticks and bricks, get a certificate of occupancy, lease up, stabilize, convert it to a cap rate and sell the asset, right? So that's opportunistic. Certainly there's a lot more moving parts in there, but the return stream associated with participation in a program is much greater. And then you have the different classifications. The nicest real estate out there typically called Class A. It's the pretty stuff. It's the stuff where we want to hang out and we want to go to lunch, but it has a lower return stream because there's not a lot of value that can be added into it. Whereas if you look at the lowest one on this rung there today would be like Class D property, which might be shopping malls. Everybody's struggling to figure out today what to do with a shopping mall, how to reposition that real estate because it's usually very centrally located, but currently most malls around the country are struggling. They're trying to figure out what to do with them. So when it comes to commercial real estate, what are we really trying to figure out? What are the demand drivers? And demand drivers are people. Right. So we want to know where the people are going, not where the people were, where the people are going to be going and why they're going to go there. So that's connected to like urban planning, future land use, and trying to figure out how to get the highest and best use out of real estate. The interesting thing about real estate in a partnership is you can structure, and I can't even see this slide from here where I'm at, so I apologize. Oh, okay. Yep. I was on the right track. Okay. So real estate as a private partnership, real estate is the economic driver that turns $1 into $2 through appreciation and or through cash flow that distributes the real estate. But how you structure the partnership interest around the real estate has some really interesting nuance to it that can create substantial tax benefits for investors to be able to participate in the programs. So passive losses that can ultimately flow through to help offset income so it can be tax advantaged. You can structure real estate for 1031 to be able to exchange in. You can structure it under 1400Z, which was part of the Tax Cuts and Job Acts, to be able to reposition capital gains. There's a lot of different tax benefits associated with private partnerships where you can squeeze some extra juice, which, by the way, the concept of tax alpha is the additional return that you get, which is accretive to the partnership above and beyond the returns that you get from a cash on cash basis. It's the tax juice that you squeeze out of it. That's where tax alpha comes from. So, some of the codes we use, 168K for bonus depreciation can pass through a partnership. On exchanges, 1400Z is qualified opportunity zone. 263C works for energy investments. 170H is for conservation rights of real estate. Cost segregation studies let you break out, what would be normal depreciation over a 30-year schedule and accelerate about 30% of the losses over the first 5 years, which creates tax-free income. That's the reason you want to know that. And then as I was going down the rabbit hole, what happened is when I was educating CPAs and attorneys along the way, they would say, hey, I've got a client that is thinking about doing this. Do you know anything about that? And so, and there's tons of different programs out there. And what I found, and it was funny that, Bob, we had this conversation earlier today, it's not uncommon for a client to ask their professional advisors about a specific strategy, and the professional advisor know very little to nothing about it, not know actually even how to do the research to determine if it's real or not real, not know how to deliver that information to the client to be compensated for the time of the research that they invested it in the first place. So by default, many professional advisors say no to everything because it protects them and it protects the client for something they probably couldn't monetize anyway. So I built a business out of saying, send that stuff to me and I'll figure it out. And so after doing this for 20 years, I get crazy stuff sent to me all the time. And we do the due diligence, and I hire law firms and CPA firms. And I spend a ton of money reverse engineering this stuff and figuring out if it's real or not real for two reasons. Number one, if it's real, I share it with the other people that we do business with. And if it's not real, we share it with the counterparty that brought it to us so that they can protect their client base from it, right? Not any more complicated than that. And so some of the things that you'll see out there is, IRC 453 is how do you sell a business and not take constructive receipt of the capital today and defer the payments over time through an installment sale. Qualified small business stock for 1202. You get to exclude up to $50 million of gain when you sell a business if you structure it under 1202. Pretty simple. Net unrealized appreciation gives you the ability to take money out of a qualified plan and bifurcate the basis from the gain, which could help convert ordinary income taxes out of a qualified plan into capital gain dollars, which is extremely tax efficient. It's about a 20-point tax arbitrage. Charitable giving. So obviously that's something that speaks to everyone here today. So there's tons of different strategies out there that if you currently have a plan giving program in place, or you currently give or want to give in a more capital efficient way, there's ways to do that. If you have a business and you have risk in your business that you can't commercially insure, there's tax advantage codes. 831B allows you to be able to potentially retain risk in a tax advantage way. Roth conversions. How many people are familiar with the concept of a Roth conversion? By a show of hands. Okay, look, smart crowd. Awesome. Has anybody that just raised their hand ever heard anybody explain to them that you could do a Roth conversion and pay the taxes at 50 cents on the dollar? Fair enough. I see some gentlemen that have been in the game for a minute shaking their head no. So, okay, good. So look, there's some creative things out there that can be done. All this is legal. Those strategies are used in estate planning all the time. It's what estate planning is used for, discounts to be able to transfer assets out of an estate underneath the exemption. You can also use it in a Roth conversion fact pattern. Passive income generators being, passive activity losses offsetting passive income generators. It's common to talk to a CPA and they have a whole bunch of clients that have a bunch of suspended passive losses that they will never be able to use in their lifetime because they only carry forward like $3,000 a year, right? So it'd be nice if you could use those before you die. They don't carry over. So we also work with a lot of attorneys that earn compensation on a contingency basis, and through Revenue Code 409A, it allows them to not take constructive receipt of that revenue and be able to defer it. And it's like putting, settling a personal injury attorney, a mass tort attorney, an eminent domain attorney. There's contingency components to their compensation, being able to defer that like into a 401k strategy with unlimited contribution amounts. Extremely useful in the right fact pattern. Qualified business income deduction, 199A. A lot of people are phased out because they make too much income to qualify for 199A. There are abilities to phase people back in through those income limitations that you can get them back in and get them the additional 20% deduction. We work with foreign nationals that own real estate in the United States. There's some quirky tax nuance to this. Is something I got brought years ago, and we reverse engineered it and figured out how to add value to foreign national investors. And then I might be done with this thing. I don't even know. So sophisticated, thoughtful strategies that can be combined to get a favorable outcome. So, look, at the end of the day, what I've spent 20 years doing is looking at the things that wealthy clients want to know, finding the best national experts in the country, paying them to teach me that thing. And then I wouldn't call myself an expert in any of those things, but I'm probably the only guy I know that knows 100 of those things, and I could triage them out because I was trained by the smartest people in those things. So that turned into a business. Didn't realize that was going to happen. For 15 years, I was just doing this kind of on a consultant basis. And about 5 years ago, the book thing happened and I decided to scale a little bit. And then today I got lucky enough to have the opportunity to talk to you fine people. So, I happen to be from Lakeland, Florida. I played football for the University of Central Florida when I was 20. I'm 51 today. And so today, Orlando, Winter Park is really more home than Lakeland is because I've been here for 30 years. I live in Winter Park. So, and that's it. So that's all I got to say. I think I squoozed in my 20 minutes. Did I not? Okay. Oh, no, I'm not 51 today. I'm 51 currently. I did not say that. I got to say that differently.
Questions? questions? I have one question. Would you comment on the current fluctuations taking place in the stock market?
Sure. Look, valuations matter, right? If there's no reasonable person that can look at the valuations in the current PE of the marketplace and tell you that we're not overly valued based on long-term averages and long-term trends. I was fortunate enough, or unfortunate enough, I would say, to have a substantial amount of my own money in the stock market in 1999 when you could put .com behind anything and it took off. To me, the AI thing feels very, very similar to that. Do I think AI will change the world? Yeah, but they told us that adding .com to pets in 1999 was going to change the world too. And the internet did change the world, but it took 10 years before anybody made any money off of it at the time. Do I think the adoption rate will be greater today? I do. Do I think AI will be disruptive? I do. But do I think all the use cases they're trying to apply it to today are going to pan out? I don't. And I wouldn't know who to bet on. So, look, and there's a lot of chaos going on in the market right now. The interest rate cycle that we've had in the past couple of years, the printing, the monetary printing, I would not be long I am personally not long the market today. I'm not here to give investment advice, but people invest in public markets with a herd mentality. And so when some people start to run for the door, like everybody starts to run for the door. Nobody wants to be first, but nobody wants to be last either, right? And that's what I think we're starting to experience, a little bit of volatility in the markets today. So maybe, was that helpful?
What's your assessment on why the market?
On what market?
Why the market went crazy?
On why the market went crazy?
Why? Yeah.
You want that one?
May I?
Sure. Yeah. Understood.
Yeah, I don't know if you, I work for a $1.6 trillion money management firm. So
There you go.
what happened was interesting. Yes, valuations are high, but they're actually not. If you take out the Mag 7, they're not as high as they
Understood.
traditionally have been or have been. But the real reason for the volatility last week was Japan was offering free money. It was called the carry trade. So the Bank of Japan had interest rates at 0. They were trying to create inflation, which wasn't happening. So you could, if you were a hedge fund, you could borrow money from Japan, go buy AI stocks here, lever it up, buy real estate, buy whatever you wanted. That game ended on Friday when the Bank of Japan raised rates while every other central bank in the world had been lowering rates or talking of lowering rates or holding them steady. So that all that free money was gone and all that leverage came out of the system in one day. Then to realize that, hey, maybe it's not that bad. Japan recovered fairly nicely by Monday, and I think we were up 500 points earlier this morning. So it's a lot of it had to do, a lot of people wanted to blame it on a unemployment print that came out on Friday. 114,000 jobs as opposed to 174,000 expected. That was not the reason. That's not a reason that the market would sell off 2,000 points. In fact, the jobless claims came out this morning better than expected. The market jumped. So we're fine.
Yeah.
I think Judd's in it as well.
Yeah, Judd Peterson. I'm with the Merrill Lynch Bank of America, small little company over on the corner. And what I've seen in my career, which goes back to the 70s, it's highly destructive real estate recessions in the 70s, early 80s, late 80s, and then again in 2008. One thing I think is better today is you have more professionally managed real estate, which is what you're talking about. And you're not going to have people invest in a mom and pop deal. They're going to be involved in professionally managed REITs. 2008 was, it took a long time for people to recover from that. And what the biggest thing I think is that in all cases, people need to be properly allocated and not put all their money in one thing. If you put all your money in tech in the late 90s, you're really pretty stupid, because worldwide kind of proverb, you don't put all your eggs in one basket, put all your eggs in one sector. People that put it all in banking and real estate before 2008, they got annihilated. They were diversified, like in Franklin Income Fund. They doubled their money from 2000 to 2009. The S&P was down 24%, but you properly invest. And my question is, after that statement, and again, I was highly involved in those real estate recessions. I was a banker from 73 to 93. And then of course, we had a lot of exposure to it since then too, in 2008. But the thing that I'm wondering about is, do you have people where you have to hold them back? They want to throw all their money in real estate, and you're going, I mean, do you kind of limit them on that? Do you try to help them properly allocate so that they don't get all the exposure into one sector?
Of course, yeah. Look, nobody's ever said diversification was a bad thing, right? But then look, diversification will keep you rich. Concentration will make you rich. And there are some people that are determined to try to be rich. So I do have a finance background. My stepdad was president of Barnett Bank like 30 some years ago. So I grew up understanding the banking stuff. I saw the S&L crisis like up front. He ended up leaving the bank and becoming a home builder. So I've been a general contractor for over 20 years. I'm a GC. I've done over 3,000 rehabs and remodels and over 100 million of new construction personally. And that's not even what I do today. That's a hobby. So what I have done is I've gone and found 200 institutional development partners that we bring capital to their deals, and we structure the partnerships for tax advantages. So every asset class and every submarket across the country with multi-billion-dollar sponsors, they're not REIT programs, they're private partnerships. So we manufacture real estate to a standard that a REIT will buy it. So we build real estate with private money and we sell it to public money with tax advantages. So pension funds, sovereign wealth funds, and REITs actually buy the assets that we manufacture. So it's a great question, but it's not really the same asset allocation question, but you would still want to diversify. Yeah, 100%.
Hey, Matt, thanks for your time today.
Yes, sir.
I'm curious, with the recent passing of the Inflation Reduction Act, if there's any tax plays that you found interesting in the sectors of manufacturing or renewables since that time.
Look, we look at renewable programs all the time. Like I know way too much about like energy and like the green initiatives. And so we like, there's some solar grid deals that we're working on right now. Solar microgrids, lots of different alternative technologies that are kind of, I would say maybe powered by those initiatives. I wouldn't tell you that I've seen anything that knocks my sock off, like that gets me super excited. I think a lot of people, and I'm going to use the term ESG, and I don't know that I think that term is kind of fading from the vernacular today. It's not used as much because there was this whole thing that we can do good for society and make money at the same time. And I don't think a lot of those ESG initiatives from a monetization standpoint have turned out the way optically it sounded good to do that, but it hasn't been the best catalyst of turning $1 into $2. And I think people are starting to pull back from that a little bit. At the end of the day, we're cognizant of what's going on there, but our goal is to help investors make more money. And then if they want to be philanthropic and give, great. If they want to be in socially responsible things with their other money, awesome. But my mandate is not really to be socially conscious or aware of those things if it doesn't help turn money into more money.
How do you select your clients, or how do your clients select you?
It's a great question. So over the 20 years, this business has been 100% referral. Normally I speak at like CPA conferences and law conferences for the bar association. I speak at commercial real estate conferences. I speak at M&A conferences. It's been like a B2B type thing. I recently got introduced to this whole concept and I was like, let's go give it a whirl and see what happens. I'm sure there's some great people there. I don't know. I can't tell you that. So everybody comes in from a referral, and I don't have what I would call a competitive model. I would call it a collaborative model. I will never tell anybody that the people that they've hired at this point in their life don't deserve to be in their life, because at the point in time when they hired them, I'm sure they thought they were the best and the brightest, and they were getting value for their dollar for the people that they put together in their life to help them make good financial decisions, whether it's CPAs, attorneys, financial advisors, whoever it is. This is not a competitive business with financial advisors, because everybody should have some form of liquid money. We don't do stocks, bonds, annuities, life insurance. I could care less. I know a lot about all that stuff, but that is not our business. That is not what we do. So we are a portion of somebody's portfolio, the portion that they want in private markets. Frankly, the structures that we access this stuff in is different than the way large groups, the big brand firms that you would know about, they access private markets in a very different way. And it's because of their business model. It's because they're in the private capital markets, they're structured more like a distribution engine. So they have to have things where they can deploy $1 billion, $2 billion of capital at a time. We underwrite deals on a deal per deal specifically, and sometimes deploy as little as $30 million in a deal. But that might be one asset in one submarket where we've bought all the data and we have a supply and demand imbalance in that asset class. And we know we'll get absorption before anything else delivers in the market, and therefore help us get outsized returns and be able to exit to public money before anybody else is aware. It's a much more nimble model to be able to do that. But it takes a lot of work to do that. And so, one of the functions that I played and I've always played is I go get boots on the ground and I look at the real estate because I have a real estate background. So anything that we do, I go get boots on the ground. I see it, I look at it locally, and I figure out if it's something that I believe is personally investable for my money. And if I wouldn't put my money in it, then I wouldn't advise anybody else put their money in it. I eat my own cooking.
Yeah, that was excellent. You went through those things so quickly. It would take somebody that was kind of used to it you didn't have to give the extra about it. But the Roth conversion, I kind of wish you to stayed on that. It probably hit, if you go to Rotary clubs, that'll probably hit more people than any other thing you talk about should be considering it, because tax rates are so low right now.
Yeah.
That you can do it. And it drives me nuts when I deal with most financial advisors. Oh, let's put away everything you can in the 401k, everything in this and everything in this. And I'm like, screw that. Figure out how to get money to a Roth.
Yeah. Yeah.
And it almost doesn't even matter the age. I mean, it certainly does, but we got a lot of young people here at 50 and 60, they should be
Sure.
considering it. So you could spend a little more time on that with a Rotary club is all I'm saying.
I'll bring it back. So for all you youngins in the room, because I was surprised there's a whole bunch of you youngins in the room, right? So look, as a married filing jointly person, the break point between the 24 and the 32% bracket is the largest delta in the tax code. It's 8 points at $383,000 a year, right? So the reason I bring that up is because if you have an IRA and you wanted to convert it to a Roth, what you're fundamentally trying to do is keep those dollars, if you can, below that 383 break point, because then your effective tax is going to be 20%. So if you have $200,000 of income, you could create another $200,000 through conversion that would now be under the 383 threshold. So if you were doing that on a dollar for dollar basis, you would take 200,000, convert it to a Roth, and you would pay taxes on it like it was ordinary. If you use the discount methodology that I'm talking about, you would take $400,000 on paper. You would make it feel like 200,000, and then you would still go under that threshold. Now, how do you do that? It's a combination of a few things. So you're going to use some discounting methodology, minority interest, lack of control, right? That are going to allow you to do that. And you're going to combine that with a real estate program that's in the phase of development, which qualifies for a J curve. You can Google and look up the J curve, or there's a chapter in the book that talks about it. So when you put minority interest and lack of control over the top of something that's in the J curve of development, you can qualify for a substantial discount. I've seen discounts on assets as much as 70% before, but I just tell people 50% because that's in the range of outcomes, right? Every project is a little bit different, pencils out a little bit differently. But then fundamentally, you've taken 400,000 and on paper, you've turned it into 200,000. You've slid it under that 383 bracket. You pay taxes at an effective 20%. And then on the other side, it turns into a Roth IRA, substantially larger, and then grows from that point. It's administrative stuff, right? And then, and I don't want to go too far with that, if you wanted to plan away the taxes that you created on the additional discounted conversion, we could plan those away as well. But that's like a 201 level thing.
Yeah, I think most of us learned something, hopefully, from our failures perhaps in your early days, maybe not now. Do you have any things that didn't work out so well? And could you talk about that?
Yeah, no, I absolutely can. So like, look, when I started getting exposed to the things that I'm exposed to today that I'm talking about, right? I am a huge cynic. Like, I don't believe anything anybody ever tells me. I trust but verify. So I have a due diligence background. So anything that I've ever been taught, and we go out and we look at the human capital in the equation, right? So like I do all the preliminary checks, but then I hire independent law firms. We do criminal and financial background checks on anybody I've ever done business with. So I want to know the people. The sixth thing is they're going to give me a deal and I'm going to look at it and we're going to re-underwrite that deal. So I'll give you an example. Let's assume somebody says we're going to build an apartment complex in Charlotte, North Carolina, and the guy gives me a pro forma and it says, here's how that is going to perform. Now, I like to think of those underwriting assessments like, like Jay-Z at a DJ board. If you've ever seen this before, like when the guy slides the thing one way, there's all these slides and other stuff moves, right? So people make an assumption that if one thing goes against it, that it ruins the deal. And that's not necessarily true. And I'll give you a real world example. Interest rates went up and has affected the cost to be able to develop real estate in the past few years. And most people go, oh my God, you can't be in the real estate game today because interest rates have gone up. Well, what has also happened is it's taken starts of real estate and dropped them through the floor because the people that aren't capitalized well enough can't start real estate. Well, when those assets land in the marketplace, there's going to be a gap between supply and demand. There's going to be a massive amount of demand and very little supply, which is, if you understand supply and demand economics, what that turns into, right? Here's the other part. The people that acquire those apartment complexes or the renters in the day also can't afford homes right now because interest rates went gone up, their mortgages are higher, and so they won't go out and buy a home. Well, that means there's more renters in a market willing to pay more in rents, and there's more demand and less supply. So we'll be able to exit those properties, even though we had a higher debt service cost along the way, and they will by far offset one another. So, and that's just one example. There's tons of examples. But my point is anytime we would look at a deal, we would have an independent person, third party underwrite that deal, somebody that knew that asset class in that submarket. How long does it take to get permits? What's the cost of construction? Reprice our concrete and know everything. Now, if we don't expect it to be dead on accurate, but we expect it to be within a range of sensitivity. If something is out on the higher side or the low side, we don't assume that they're wrong or they're lying to us, because remember, we did a background check on the human capital and we like the humans. We think they have the right experience and they're good people. So we go and ask them, why do you get these numbers differently than what we did with our underwriting? And we give them the ability to support the information that they provided that was incongruent with our secondary underwriting. So we like the human capital. We like the deal. We think it pencils out. And then the third thing we do, if it has substantial tax benefits, we go and get a tax opinion from a large law firm, because investors are going to put capital into it, wanting to get those tax benefits associated with it. And if they take the position that they qualify for those and they don't, they're going to want somebody to step between them and the IRS to do the tax controversy work. And it's not going to typically be the CPA that they work with that files their return, because that's not what their skill set is.
Thanks for great education.
Hope that was helpful.
Hold on. We have a little gift for you. It is a one of a kind, well, one of 1.4 million kind. It is a coffee mug for you.
Awesome.